Hey guys, welcome back to the Bitcoin Fortress podcast. Today is February 22nd, 2026, and we are at block height 937,854, Moscow time 1483, and fees are a peaceful 1, 1, and 1. If you're new here, this show is about staying high signal, filtering the noise, and understanding what matters to Bitcoiners. Self-custody, freedom tech, incentives, and the long game. This week feels like one of those quiet on the surface, loud underneath weeks. ETF flows are flickering back to green. Lightning adoption is showing real utility growth. Miners just got hit with a monster difficulty jump, and strategy is doing what strategy does, buying more Bitcoin into the volatility. So with that, let's get to our top stories. First up, market structure ETFs and flows. Spot Bitcoin ETFs flipped back to net inflows, at least for a day. US spot Bitcoin ETFs reportedly posted about 88 million net inflow on February 20th, led by IBIT and FBTC. In downtrends, flows often act like a risk-on, risk-off sentiment gauge for TradFi allocators. Even small green days can signal stabilization. So, the story isn't ETFs save Bitcoin. The story is ETFs are new transmission line between Bitcoin and conventional portfolios. One green day doesn't erase bigger red weeks, but it can mark a shift from panic to boredom. For Bitcoiners, ETFs are liquidity plus exposure, but self-custody is still the point. And of course, watch the trend and the persistence, not single-day prints. Price action remains range-bound around the high 60s. Reports framed Bitcoin hovering around 68K, with market caution and softer ETF momentum in the background. Sideways markets are where weak hands exit and conviction gets built. When fees are low and the price is boring, that's often when serious Bitcoiners do the unsexy work. Consolidation, UTXO cleanup, moving to cold storage, updating node and wallet hygiene, and of course, stacking cheap sats. Range is an opportunity for disciplined buyers, but also a psychological grind. Moving on to institutional and corporate Bitcoin. First up, Strategy adds some more Bitcoin. Strategy disclosed another purchase around 2,486 Bitcoin, roughly $168 million, average around 67,700, pushing its holdings even higher. Love them or hate them, Strategy is still the most visible corporate Bitcoin balance sheet strategy in the world. This is anti-time preference in public markets, buying when sentiment is sloppy. Key distinction, Bitcoin, the asset, is decentralized. Strategy is a leveraged proxy with its own risks, equity dilution, financing structure, volatility, etc. So, don't confuse Strategy did it with you should. Bitcoin is a bearer asset and your strategy can be simpler. Large European bank exposure to Bitcoin ETFs. And this is more evidence that TradFi is quietly accumulating. So what happened? Spain's Cinco Dias reported Intesa San Paulo had 80 million euros plus of exposure to crypto-related assets, including Bitcoin ETFs. Positions were cited in ARCB, IBIT, etc. This is the slow institutional normalization trend, not laser eyes, but balance sheet creep. Big banks don't buy the top headlines. They buy frameworks, custody, compliance rails, and ETFs. This reinforces Bitcoin adoption, often looks boring, right until it doesn't. All right, moving right along. Next up, we will talk about mining hash rate and network fundamentals. First up here, mining difficulty jumps 15%, largest absolute increase on record. So what happened? Difficulty rose about 14.7% to 144.4 terahash, reported at or around block height 937440, after hash rate rebounded following U.S. winter storm curtailments. This is Bitcoin's immune system in action. The protocol adjusts, no committee required. So the storm knocks miners offline, blocks slow, difficulty drops. Then the miners return, hash rate surges, difficulty snacks back hard. This is why Bitcoin is robust. Incentives plus automation plus no central switchboard. For miners, brutal whiplash, but for the network, resilience. Hash rate volatility, as a reminder, Bitcoin is physical infrastructure. Coverage emphasized how storm-driven disruptions hit major pools and then normalized. Bitcoin is math is true, but it also lives in warehouses, weather, grids, and real-world constraints. The more mining professionalizes, the more it interacts with energy markets, curtailment programs, power credits, grid balancing. And this is part of the long-term thesis. Mining becomes an energy buyer of last resort. Moving right along to payments and adoption, Lightning is getting real. Lightning Network crosses an estimated $1 billion plus monthly volume milestone, according to data from River. River estimated Lightning processed $1.1 to $1.17 billion in November 2025 across 5.2 million transactions. Multiple outlets reported the milestone this week. Price can chop sideways while utility compounds, and this is what you call utility compounding. The narrative is maturing from Lightning Network is for coffee to Lightning Network is also for exchange settlement rails. River's framing, growth even during a weak flat price period, adoption isn't purely speculative. This matters for the Bitcoin is dead crowd. Dead things don't grow payment volume. Lightning transaction sizes are rising. Less toy payments, more real transfers. Reports highlighted average Lightning Network transaction value rising. River's analysis noted larger average transfers and exchange-driven flows. This is how networks grow. First experimentation, then serious use cases dominate. Humans have mental transaction costs, machines don't. If AI agents start doing microtransactions, Lightning Network becomes the default native rail for machine-to-machine value transfer. And we'll talk a little bit more about that when we get to the podcast themes. Next up, let's tackle Bitcoin security and user safety. So safe transaction UX and address level scams are rising. Consumer reality check here. Recent SLP content is laser focused on transaction safety, scams, and verification because this stuff is hitting normal users now. Again, that's the Stefan Livera podcast. The next wave of adoption will be won or lost on UX plus safety. Hardware wallets and good habits matter more when fees are low and people get lazy. Verify addresses, verify intents, slow down. Bitcoin doesn't need permission, but you still need discipline. Moving on to the macro and narrative backdrop. ETF flow narratives continue to shape day-to-day sentiment. Mainstream market coverage continues tying Bitcoin moves to macro prints plus ETF positioning. This is the new normal. Bitcoin is increasingly treated like a macro asset by commentators, even if Bitcoiners treat it like savings tech. Short-term headlines trade, long-term fundamentals build. You can acknowledge macro without becoming a chart-addicted leaf in the wind. Best Bitcoin ETF style coverage keeps pulling retail through the TradFi doors. Mainstream outlets continue publishing explainer style ETF guides, IBIT, FBTC, etc., framing Bitcoin exposure as normal investing. Why does this matter? Well, this is onboarding via familiarity, brokerages, retirement accounts, and quote, safe wrappers. ETFs lower friction, but they also normalize the idea that Bitcoin belongs in retirement planning. That tees up our featured Substack later on perfectly. More on that later. Okay, a couple other items. First, Lightning and AI payments narrative continues to surface. Cointelegraph reported this one, that even mainstream coverage for River's Lightning Network data is explicitly connecting Lightning to potential AI agent payments. Machines do not care about banking hours, and oh, by the way, they can't do KYC either. Mining difficulty headlines is basically free marketing for Bitcoin's robustness. Secondary summaries, such as BitBo, make the difficulty adjustment story digestible for normies. The punchline here is no meeting, no bailout, it just adjusts. Corporate Bitcoin accumulation remains a story, even in drawdowns. Strategies buying is the clearest example this week. Conviction looks like buying when it's uncomfortable. And finally, the boring week signal. Low fees, stable range, steady infrastructure growth is basically the ideal environment for builders and serious stackers. All right, next up, let's take a look at the podcast universe. Theme 1, Lightning is graduating from demo tech to real settlement rails. CoinStory's news block on February 16th covered this, touched on Lightning plus AI agent wallet payment narratives. And River Lightning, $1 billion a month, became a broader talking point across the space this week. The world is slowly discovering Bitcoin is not just an asset, it's an internet-native settlement layer. Theme 2, Mining and Energy Realism and the AI Energy Collision Course. First up, the Stefan Livera podcast, Monetizing the Megawatt, on February 17th, talked about mining, energy markets, and the evolving narrative. Mining isn't a bug, it's a feature that turns stranded curtailed energy into global money security. Theme 3, Bitcoin security, scams, transaction safety are now front and center. Again, Stefan Livera, is your Bitcoin transaction safe? From his episode on February 19th, User Safety, Scam Vectors. Adoption means adversaries. The protocol is secure, but humans are the soft target. Theme 4, the spam ordinals on-chain policy debate keeps resurfacing. Again, from Stefan Livera, Bitcoin spam debates on February 21st. Ongoing debate about arbitrary data, trade-offs, and proposed changes. Bitcoin survives because it can host disagreement without someone being able to win by decree. That is how the protocol works. Therefore, change is slow, which is good because you're talking about money here. And finally, to wrap it all up, theme 5, retirement, credit markets, and Bitcoin as pristine collateral. First, Coin Stories on February 19th talked a bit about retirement shortfall and Bitcoin and retirement accounts. Coin Stories on February 17th also hosted Lynn Alden with macro catalysts and sentiment analysis. Great podcast. Highly recommend you listen to it. Always enjoy listening to Lynn. Very calm, very level headed, and always has some good takes. The big one, of course, is that she sees a small print, not a big print, coming from the Fed, which is generally supportive for Bitcoin because they have to keep printing money in order to continue to fund the government. Bitcoin isn't just number go up, it's a financial gravity well pulling long duration savings into a harder asset. And we are still early, in my humble opinion. Okay, next up, I want to talk about the featured Substack post, the Bitcoin retirement plan. It was actually a two-part series that I posted last week, so the link will be the second part of that, which I posted on Friday. I'll keep this simple. Most retirement planning is built on assumptions that quietly break under monetary debasement. Steady real returns, stable purchasing power, and a system that doesn't change the rules mid-game. The Bitcoin retirement plan is basically a refusal to play pretend. The idea is not trade Bitcoin. The idea is save in the hardest money available. Keep your time preference low and structure your life so your future purchasing power isn't hostage to policy. If you want the full write-up with the reasoning and the practical framing, it's on Substack, and it pairs perfectly with what we're seeing in mainstream media this week. More ETF normalization, more retirement account on-ramps, and more people asking the obvious question, what if the old plan doesn't work? Quick reminder, if you want to go deeper, I've got 3 Bitcoin Fortress books available on Amazon, many formats available. The first is Bitcoin Fortress, a simple guide to Bitcoin for beginners, Bitcoin retirement and estate planning, and finally, the Bitcoin lifestyle. These books are designed to be straightforward, practical, and aligned with what we talk about here every week. Self-custody, long-term thinking, and building a life on solid money. Well, folks, that wraps it up for this week. If you got value from this episode, please share it with a person who needs fewer headlines and more signal. Stay humble, stack sats, and I will see y'all next week. Bye-bye.